As of 10:46 a.m. Eastern Time on Monday, February 2, 2026, Supermicro Computer Inc., trading under the ticker SMCI, is priced at $29.53 per share, marking an intraday increase of 1.44%. The stock opened the session at $29.03 and has fluctuated within a range of $28.80 to $29.60 so far today. While the broader indices are showing relatively stable behavior, SMCI is attracting significant eyeballs as it gears up for its second quarter fiscal 2026 earnings report scheduled for tomorrow, February 3rd. Many retail investors and those utilizing the Robinhood app or Interactive Brokers trading platforms are closely watching to see if the company can finally move past the accounting and reporting cloud that has shadowed its fundamental growth for over a year. The expectation in the air is palpable. Most people see Supermicro as a high-octane bet on artificial intelligence infrastructure, sitting right next to big names like NVIDIA stock or Tesla stock in terms of market hype. The common narrative is that as long as the world needs servers for large language models, Supermicro will keep printing. But here is the reality check that the headlines often miss. The growth story isn't just about demand anymore. It is about the cost of keeping up. We are seeing a massive shift where the company's gross margins are being squeezed, dropping from previous highs of 14% down to the 9% range. This isn't just a minor dip. It suggests that while the volume is high, the competition is getting fierce, and the premium for their speed-to-market advantage is eroding. If you're doing your online investing through something like SoFi Invest or Fidelity Invest, you've likely noticed the wild swings this stock takes. It is no longer the steady climber it was in early 2024. Today's volume is currently sitting at 4.8 million shares, which is relatively light compared to its average daily volume of over 24 million. This suggests that the big institutional players might be sitting on their hands, waiting for tomorrow's earnings call before making a decisive move. It's a classic wait-and-see scenario. While individual brokerage accounts might be nibbling at these levels, the heavy lifting usually happens after the guidance is issued. Investors using Schwab Intelligent Portfolios or other automated online investment tools are seeing SMCI as a volatile component that can drastically shift a portfolio's risk profile in a single afternoon. If the company fails to provide solid guidance for the rest of 2026, we could see a test of that 52-week low of $25.71. The recent price action has been a roller coaster. Just a few weeks ago, the sentiment was extremely bearish, with some analysts calling it priced for failure. Now there's a contrarian wave of optimism. People are looking at the projected fiscal 2026 revenue of $36 billion and wondering if the market has overcorrected. This tension between the accounting trauma of the past and the revenue powerhouse of the future is what makes SMCI one of the most polarizing stocks on any investing sites today. If you are using SoFi Active Investing or the Robinhood stock trading interface, you are likely seeing a lot of chatter about whether this is a generational buying opportunity or a value trap. The reality is likely somewhere in the middle, hidden in the fine print of their supply chain logistics. One thing we have to talk about is the liquidity and the leverage. When you look at the activity on the Interactive Brokers platform, you see a high level of options activity. People aren't just buying shares, they are betting on the magnitude of the move. For those managing their own Fidelity IRAs or utilizing Fidelity brokerage services, the volatility in SMCI can be a double-edged sword. It provides the chance for rapid growth, but it also necessitates a very disciplined approach to risk management. Unlike a more stable play like Apple stock, Supermicro requires constant monitoring. If you are the type of investor who likes to set it and forget it, this probably isn't the ticker for you. Let's get into the institutional side of things. We've seen some shuffling of positions from major asset managers. Fidelity Investments and various Fidelity ETFs have had to rebalance their holdings based on the shifting market cap of SMCI. When a stock goes from being a mid-cap darling to a multi-billion-dollar AI play and then gets hit with a 50% drawdown, it creates a lot of forced selling and buying. This institutional churn is partly why we see such aggressive price gaps. Institutional activity is the heartbeat of a stock like this. If the big banks and hedge funds aren't convinced that the internal controls are fixed, no amount of revenue growth will keep the stock price elevated in the long run. Comment below how many shares of Supermicro you currently hold and what your average cost basis is. It's always interesting to see where the community stands on these high volatility names. Now, looking at the business model itself, Supermicro positions itself as a total IT solution provider. In plain English, they build the boxes that hold the brains of the modern internet. Their specialty is liquid cooling and high-performance computing. They claim to have a 70 to 80% market share in liquid cooling solutions, which is vital because AI chips run incredibly hot. If you can't cool the chip, you can't run the model. This is their moat. However, that moat is being tested by giants like Dell and HP who are aggressive with their pricing. This is the reality check. Supermicro is a hardware company at the end of the day. Hardware businesses are notoriously difficult because of low margins and high capital expenditures. They have to spend money to make money, and when interest rates or supply chain costs fluctuate, those profits can vanish quickly. The company's history is one of rapid scaling. They were founded in the 90s and spent decades as a niche player before the AI boom propelled them into the stratosphere. But with that rapid growth came the growing pains of financial reporting. The delay in their filings and the change in auditors created a crisis of confidence. Even if you're using the best investment help or the most sophisticated SoFi robo-advisor, you can't automate away the risk of black swan corporate governance issues. This is why the stock is trading at a P/E ratio of around 23, which is actually quite low for a company growing revenue at this pace. The market is effectively applying a trust discount to the stock. If we look at the broader sector, the momentum is still largely positive. NVIDIA stock remains the bellwether, and as long as NVIDIA is selling chips, Supermicro has something to put in its servers. But we are starting to see a bottleneck narrative. It isn't just about getting the chips, it's about the power grid and data center space. Supermicro is trying to pivot from just selling servers to selling time to online, essentially helping companies get their data centers up and running faster than anyone else. This is a clever strategic move, but it remains to be seen if it can offset the margin compression they are facing. For those of you involved in online investing, whether you're using the Fidelity mobile app or the Robinhood app, you have to consider the macroeconomic pressures. Inflation and interest rates still matter for a company that carries a lot of inventory. Supermicro needs a lot of cash to buy the components they assemble. If the cost of that capital stays high, it eats into the bottom line. This is why self-investing requires a deep dive into the balance sheet, not just the story of the stock. As we look toward the future outlook, there are two main scenarios. Scenario A is that tomorrow's earnings report shows a clean bill of health, solid margins, and a clear path to that $36 billion revenue target. In that case, the expectation of a recovery meets the reality of strong execution, and the stock likely gaps up significantly. Scenario B is that the margins continue to slide, and the company provides vague answers about its internal controls. If that happens, the reality will fall short of the already tempered expectations, and we could see another round of liquidations. The key takeaway here is that the market is currently a show-me market for SMCI. The time for hype is over. Now it's time for the numbers to do the talking. The stock's current price of $29.53 reflects a market that is cautiously optimistic but ready to bolt at the first sign of trouble. Whether you are using Interactive Brokers stock trading for its low fees or Fidelity Wealth Management for a more guided approach, the lesson is the same. In the world of high-tech hardware, your competitive advantage is only as good as your last quarter's margins. In summary, Supermicro is at a critical juncture. We started today with a slight intraday gain, but the real story is the tension leading up to the February 3rd report. We've looked at the expectation of AI-driven growth versus the reality of margin pressure and governance concerns. We've seen how institutional activity and retail sentiment on platforms like Robinhood and SoFi are keeping the volume churn high. The company's lead in liquid cooling remains its strongest asset, but the pricing war in the server market is a real and present danger. As you navigate your own online investment strategy, remember that the most successful investors are those who can distinguish between a temporary setback and a structural flaw. Supermicro has the revenue. Now it needs to prove it has the discipline. Would you like me to analyze the potential impact of tomorrow's earnings report on the broader AI hardware sector?